Before you assume your charting software is broken or your coffee was spiked, take a breath. What you're seeing is real. Silver didn't climb today, it didn't rally, it didn't even spike, it jumped dimensions. In a single trading session, the market repriced itself by $6 and change, landing near $78.83. That's an 8.25% move in one day. For silver, that's loud. For Tuesday morning, that's borderline unhinged. Markets don't behave like this when everything is normal. They don't gap higher by nearly 10% unless something underneath them has snapped. This wasn't enthusiasm. This wasn't momentum traders discovering a breakout. This was pressure finally overwhelming structure. The kind of move you see when liquidity evaporates and price becomes the only thing left doing the talking. We've been warning that Western pricing was out of sync with reality. New York had been trading silver like it was surplus inventory. The rest of the world disagreed. That disagreement just got resolved in one very violent session. The elastic band didn't stretch further. It broke. Even after today's explosion, the story isn't finished. Data out of the Shanghai Gold Exchange shows silver trading near $83.98. That's still about $5 above the US price. In other words, New York is celebrating a victory lap while still chasing the global market from behind. The gap hasn't closed, the magnet is still on. So what actually happened today? Why did price behave like it was shot out of a railgun? To understand that, you have to forget indicators for a moment and think about market physics. In a healthy, liquid market, sellers are stacked at every level. Someone is happy to sell at 73, another at 74, another at 75. Buyers chew through those offers one by one. It's orderly, it's slow, it's boring. Today was none of those things. When buyers showed up, the sell side wasn't there. The order book was thin to the point of embarrassment. The usual sellers, particularly the banks that habitually lean on the price, stepped back, not because they suddenly became bullish, but because they became rational. Selling silver at $75 in New York, while it trades near 80 brawler in China, is just donating money to arbitrage traders with good logistics. So the banks pulled their offers. And when real buyers hit the market, pension funds, industrial hedgers, institutions that don't care about RSI, they walked into an empty room. They hit the buy button and price didn't move smoothly. It skipped from 73 to 75 to 78, like there were missing stairs. That's not a rally, that's teleportation. This is what happens when available trading inventory vanishes. The float dries up. Price has to jump farther and faster just to find someone willing to transact. Volatility isn't a flaw in this environment, it's the mechanism. When there's no physical buffer left, price becomes the shock absorber. Now let's talk about that Shanghai number because it matters more than most people want to admit. 83.98 isn't just a data point, it's a gravitational force. For weeks, New York lagged behind. When New York was at 72, China was near 80. When New York hit 75, China was already pushing 82. Two prices for the same asset cannot coexist indefinitely. It violates the most basic rule of markets, the law of one price. Arbitrage traders exist to enforce that law, and they are ruthlessly efficient. They don't care about narratives. They don't care about overbought conditions. They care about spreads. And right now, that spread is still wide enough to drive serious capital through. Buy the cheap contracts in New York, sell the expensive ones in Shanghai, repeat until the gap closes. That buying pressure is mechanical. It's relentless. It doesn't pause to ask if the move feels extended. As long as New York is cheaper than Shanghai, the trade stays on. Even at $78, the US price is still playing catch-up. That alone tells you this move likely isn't done. This also explains why the Western price is being dragged higher rather than leading. Pricing power has shifted east. The West is no longer setting the tone. It's responding to it. That's a structural change, not a headline. Now imagine being short into this. Somewhere out there, a hedge fund manager sold silver at $75 last week, confident they'd caught a double top. This morning, they woke up down $6 per contract. On a standard futures position, that's roughly $30,000 per contract. Hold 100 contracts, and you're staring at a $3 million loss before breakfast. At that point, the trade is no longer yours. The broker's risk desk takes control. They don't debate, they don't strategize, they just buy. At 76, at 77, at 78, whatever the market will give them. That forced buying is completely price insensitive, and it pours gasoline on an already thin market. This is how squeezes feed themselves. Higher prices trigger liquidations. Liquidations trigger buying. Buying pushes prices higher. We are watching a gamma squeeze and a short squeeze collide in real time, and the result is not subtle. You might expect that at these prices, the physical market would cool off, that premiums would compress. They haven't. Dealer spreads are holding firm, in some cases rising. Physical sellers see the same global pricing data. They know $78 is still discounted. No one is eager to sell inventory today that will cost significantly more to replace tomorrow. That's an important confirmation. In fake paper rallies, futures run ahead of physical. premiums soften. Supply magically appears. That's not what's happening here. Physical pricing is leading, not lagging. The street is validating the screen. This isn't a bubble forming. It's a repricing underway. Volume tells the same story. This move wasn't built on empty air. Billions of dollars traded hands. Institutions showed up in size. This wasn't a crowd of retail traders chasing a candle. This was pension money, industrial money, balance sheet money stepping in and building positions at 76, 77, 78. High volume on a rising price isn't noise. It's commitment. It suggests a new floor is being poured, not a top being blown off. And silver isn't acting alone. While everyone was watching silver go vertical, gold made a move that is, statistically speaking, even more important. Gold was up $135 on the day, roughly 3%. That may not sound dramatic until you remember what gold is. It's a $15 trillion asset. It doesn't sprint, it glides. A 3% move in gold is the equivalent of the Dow swinging 1,500 points in a session. Those kinds of moves don't happen during calm markets. They happen during crises, during wars, during banking failures, during moments when confidence cracks. Gold doesn't shout unless it has to, and today it raised its voice. At around 40,167, gold is sending a signal that goes well beyond metal supply. It's flashing a systemic warning. Something in the financial architecture is under strain. Capital isn't just chasing returns, it's seeking refuge. Silver, in that context, becomes gold with leverage. Smaller market, thinner liquidity, same monetary undertow. When capital moves for safety and scarcity at the same time, silver doesn't walk, it runs. So yes, today was about silver, about arbitrage, about shorts getting carried out. But it was also about something bigger, a shift in pricing power, a recognition that prior prices were wrong, and a reminder that when markets reprice under stress, they don't do it politely. The dam didn't crack today, it failed, and the water is still moving. Follow the money, not the noise. When you do that right now, the picture becomes uncomfortably clear. The smartest capital on the planet, the central banks, sovereign wealth funds, and institutions that don't tweet their trades, is quietly but decisively stepping away from the dollar. They're backing out of bonds, avoiding counterparty exposure, and concentrating capital into the one asset that doesn't rely on someone else, as promised to pay. That move alone explains why silver is doing what it's doing. This isn't a social media frenzy, it's a monetary migration. Silver isn't rising because a chat room got excited. It's rising because the global financial system is being repriced in real time. Gold is leading that process, as it always does. Silver is simply drafting behind it. And when the king accelerates, the prince doesn't jog, he sprints. This is where the concept of beta matters. In finance, beta measures how violently an asset reacts relative to a benchmark. Historically, silver has been gold with leverage. Its beta tends to sit between 2 and 3. If gold moves 1%, silver typically moves 2 or 3. That relationship held perfectly today. Gold surged roughly 3%. Silver jumped over 8. That's not chaos. That's textbook behavior in a functioning precious metals bull market. This correlation is important because it acts as a reality check. If silver had ripped 8% while gold did nothing, alarms should be blaring. That would look like speculation outrunning fundamentals. But that's not what happened. Gold made a historic move first. Silver followed. That sequencing matters. It tells us this rally is built on foundation, not froth. And what we're watching is the repricing of hard assets against fiat currency. Gold is doing the heavy lifting because that's its job. Silver is benefiting from the overflow. The flood of capital exiting the dollar is simply too large for the gold market to absorb on its own. So it spills. And when it spills into silver, a much smaller, thinner market, the result isn't a ripple, it's a wave. That raises the obvious question. Why now? Why did gold jump $130 on a random Tuesday in January? Yes, there's geopolitical noise out of Venezuela, but geopolitical headlines usually cause short-lived spikes. This move didn't fade, it intensified into the close. That's the tell. When price accelerates instead of cooling off, it usually means risk has shifted from geopolitical to financial. Gold behaves like this when the market senses stress in the plumbing. A bond market problem, a banking problem, a currency problem. Historically, moves of this magnitude in gold often precede major disclosures. Someone is acting on information that hasn't made it to the press yet. Maybe a central bank is quietly unloading treasuries. Maybe a currency peg is wobbling. Maybe a regional conflict is about to widen. We don't know the headline yet, but we don't need it. Price is the headline. What the price is saying is simple. Safety is suddenly scarce. And when safety gets scarce, gold gets expensive very quickly. At over $4,400 an ounce, gold is becoming inaccessible for the average retail investor. Silver fills that gap. It's the affordable safe haven. When gold starts to look like a luxury item, capital substitutes into silver. That substitution effect is powerful, and it's only beginning. You can see this dynamic clearly in the gold to silver ratio. At the start of the week, it was hovering near 60. After today's move, with gold around 4,167 and silver near $78.88, the ratio has compressed to roughly 56. That compression means silver is outperforming gold, which is exactly what happens as a bull market matures. During the mania phase, that ratio doesn't stop at average, it overshoots. Historically, it has collapsed to 40, then 30, and in extreme cases, even lower. At 56, silver is still nowhere near historically expensive relative to gold. In fact, it remains undervalued. If the ratio were to return to the 2011 lows around 30 to 1, and gold didn't move another inch, silver would be trading near $148. That's not a prediction. It's just arithmetic. And the algorithms know it. That's why they keep buying silver and trimming gold. The ratio trade is mechanical. And as long as gold remains strong, the mathematical floor under silver keeps rising. Gold is acting as the shield in this environment. Silver is the sword. One preserves wealth, the other amplifies the move. Now layer in the macro calendar. The U.S. debt ceiling deadline is approaching in the first quarter. Treasury cash balances are thinning. The bond market can read a balance sheet just as well as a spreadsheet, and it's getting nervous. A 3% move in gold is often a silent vote of no confidence in a government's ability to fund itself without monetary debasement. This is fiscal dominance creeping into the market's consciousness. That's the uncomfortable theory that once debt reaches a certain level, central banks lose independence and are forced to print to fund government spending. When that happens, fiat currencies don't decline gracefully. They unravel. Hard assets don't rise slowly in that environment. They reprice violently. The market is starting to accept that the debt spiral has no clean exit. Default is unthinkable. Austerity is politically impossible. That leaves inflation. If inflation is the only door left open, capital rushes through it early. That's what today looked like. Not speculation, an exodus, but financial markets are just the surface. The real story is unfolding far away from trading desks, inside factories that don't care about narratives or charts. On factory floors across Asia and the United States, today's silver move triggered a very different kind of panic. For a trader, missing a move hurts the P&L. For a manufacturer, missing silver shuts down production. With silver jumping $6 in a day, the global supply chain felt a jolt. Procurement managers don't see an 8% price increase and think expensive. They think shortage. Picture yourself as the head of procurement for a major solar panel manufacturer. Your facility produces millions of dollars in panels every day. Silver paste is essential to that process. It might represent 5 or 10% of your total cost structure. Yesterday, silver was $72. Today, it's $78. Does that make you stop buying? Of course not, because without silver, you can't finish the product. Without finished product, revenue goes to zero. Saving 5% on costs doesn't matter if you lose 100% of sales. That's price inelasticity. Industrial buyers don't respond to price. They respond to availability. When price spikes sharply, they don't back away. They rush forward. A sudden move higher signals risk of shortage, and shortage is existential. We're already seeing reports of industrial users doubling orders, abandoning just-in-time delivery in favor of just-in-case stockpiling. That behavior drains inventories and turns a spike into a spiral. Now, look at the retail bullion market. For dealers, today was controlled chaos. Imagine holding 10,000 ounces bought at $70. On paper, today looks fantastic, but replacement risk is everything. If you sell inventory at $79 and can only replace it at $85, or can T replace it at all, you didn't audit T make money. You made a mistake. In fast vertical markets, dealers protect themselves the only way they can. They widen spreads, premiums jump, inventory disappears. Spot might say $78.83, but try buying a Silver Eagle today. And you were staring at 95 or a polite or out-of-stock message. That's not greed. That's survival. Paper prices can rise all day. Physical reality is less forgiving, and right now, physical metal is vanishing faster than screens can update. This is what a real shortage looks like. What's happening now goes beyond charts and tickers. Dealers aren't just widening spreads anymore. They're pulling inventory altogether, not because they're greedy, but because volatility like this can wipe you out faster than a bad trade. When prices move this violently, survival means stepping aside. The result is a physical lockout. Your screen might say silver is trading at $78, but try converting paper dollars into actual metal at that price, and you'll hit a wall. The real-world cost to get silver in your hand is racing toward triple digits. The paper market is trailing physical reality by $20 and losing ground by the hour. That divergence matters. It tells us the future's price is no longer the truth. It's a delayed signal. Physical demand is broken away. And when that happens, paper eventually snaps to catch up. This isn't theoretical. It's already happening at the dealer level, and it's spreading. Now let's talk about the mining companies, because this is where things start to get interesting. At $78 silver, primary silver miners are generating cash flows that would make Silicon Valley jealous. Their cost structures are relatively fixed. Diesel didn't jump 8% today, labor didn't spike 8%, steel didn't suddenly reprice overnight, revenue did. That entire $6 move flows almost cleanly to the bottom line. On paper, these companies just had their margins explode. But if you look at the mining stocks, many of them aren't up 8%. Some are barely green. That disconnect isn't because the fundamentals are weak. It's because the broader equity market is uneasy. War headlines out of Venezuela rattled the S&P 500, and when fear creeps into equities, generalist investors sell first and ask questions later. Miners get thrown out with everything else. That creates a valuation anomaly. You now have silver producers trading at earnings multiples you'd expect in a recession, not during a metals breakout. Some are priced at 3 times earnings. Others are sitting on dividend yields that are about to look ridiculous once cash flow statements update. The market hasn't recalculated yet. Analysts are still working with old price decks. They haven't realized that at $78 silver, these aren't speculative miners anymore. They're industrial scale cash machines. This lag is normal. Metal moves first. Stocks follow later. We are firmly in the metal move phase. The stock catch-up phase usually arrives a few sessions later, once spreadsheets get revised and price targets suddenly look laughably conservative. If you missed silver's vertical move, the miners are still sitting on the clearance rack for now. Let's check back in with our favorite truth serum, Shanghai. We opened this discussion with silver trading near $84 in China, while New York was far behind. New York has since rallied hard to $78.83. Did we close the gap? Not even close. We narrowed it from $10 to $5. And $5 is still a massive arbitrage. That gap means metal is still flowing east. The vacuum is still active. Pressure hasn't equalized. This is critical. If $78 were the top, New York would be trading above Shanghai. We'd see Western prices overshoot and then correct. Instead, we're still the bargain bin. As long as Shanghai leads, New York must follow. Arbitrage isn't optional, it's physics. The market will force convergence whether participants like it or not. So take stock of the environment. Industry is hoarding. Dealers are freezing sales, miners are printing cash, China is still paying more. This is not a topping structure. This is an acceleration structure. Which brings us to the uncomfortable question everyone is quietly asking. Where does this end? Above $80, we enter what traders call blue sky. No historical resistance, no old supply waiting to get out, no one underwater looking for relief. Everyone who owns silver is in profit. When markets enter blue sky, price doesn't grind, it explores. The only resistance left is psychological, and psychology tends to shatter faster than charts. Round numbers like $100 matter, not because sellers live there, but because humans do. That's a mental wall, not a structural one. And mental walls crack under momentum. If silver can move $6 in one day below $80, $10 days above $80 are not out of the question. Speed increases when compression releases, especially in a market that's been artificially restrained for decades. Now we need to address the most dangerous enemy you face at this stage of the move, vertigo. After years of grinding sideways, watching a vertical chart can make even seasoned investors uncomfortable. Your instincts start screaming that this can't last, that you should take profits, that bubbles always pop. That voice is powerful and often wrong. Ask yourself a simple question before you sell. What are you selling into? Cash, the very thing silver is rising against. Silver isn't going up because it's suddenly fashionable. It's rising because fiat currency is being repriced lower against real assets. Debt levels are unsustainable. Geopolitical risk is spreading. Monetary credibility is eroding. Selling silver for dollars right now is like trading a fire extinguisher for gasoline during a house fire. You're swapping a defensive asset for the source of the problem. Smart money doesn't sell into cash during currency stress. They rotate. They swap undervalued assets for less undervalued ones. That's where the gold to silver ratio comes back into play. At 56, silver is still cheap relative to gold. Historically, the ratio bottoms closer to 15. That implies silver has room to double against gold, even if gold doesn't move another inch. The ratio is telling you this is not the time to exit. It's the time to hold. If someone absolutely must reduce exposure, the intelligent move isn't into dollars, it's into gold. But even that trade is premature. The ratio says stay put. Another factor most people are underestimating is the public. Today's 8% move will be on every financial channel. It will flood social media. The average person is only now realizing silver exists as an investment. They haven't bought yet. They're still opening brokerage accounts. They're still Googling how futures work. That means the retail wave hasn't even arrived. We are still in the institutional phase. Institutions buy quietly. They don't chase headlines. When the public shows up, that's when markets detach from logic and enter mania. That S when silver doesn't move from 78 to 85. It moves from 80 to 150. You don't want to sell before the mania. You sell into it. When your Uber driver starts giving you silver tips, that's your cue. We are nowhere near that stage yet. So here's the final verdict. The market structure has broken. The West lost pricing control because it lost physical metal. The East now leads because it has the demand and the willingness to pay for real supply. The arbitrage gap is forcing a repricing across the entire precious metals complex. $78 isn't a bubble. It's a correction to reality. Silver is scarce, strategic, and essential. For decades, the paper price masked that truth. Today, the mask slipped. Your strategy doesn't need to be complicated. Ignore intraday noise. Ignore the volatility. Watch Shanghai. As long as China pays more, the trend remains intact. Watch gold. As long as gold sits at record highs, the system is under stress. You're positioned in the asset the world needs, not the one it's running from. Don't let fear shake you out. Don't let speed confuse you. The squeeze is active. Triple digits are not a fantasy. They're the math. And this move is still in its early chapters.